I will start off and then I'll show you guys the first slide. But I'm David Elder, wealth manager and partner here at Merit Financial Advisors, and really just have a passion of helping people proactively think through their finances, and because of that, not have regrets or mistakes. And I will tell you, whether you have $1 million, $100,000, or $10 million, it's easy to make financial mistakes, and I've seen a lot of them in election years. And most of the time, it's not for valid reasons. A lot of times, it's more because of a person's view or fear. And as we all know from the genius of Warren Buffett, we're supposed to be investing when others are fearful and be fearful when others are greedy. And a lot of times that'll make people make the wrong decisions at the wrong time. And so I wanted to go into a little bit of context on historically how this has worked, a little bit of context on maybe if this time is any different, and also talk about, just some long-term market trends with that. Does that sound all right to you guys, or do you guys have anything else you'd like to have added? All right. So let's come back. Let's start off here at the beginning. Is this time different? And I don't have many good political jokes, but I'm hoping you guys can enjoy this one. This time is different. It is different in this way. Certainly in history, I'm not sure. I think this is only the second time that two people have run against each other again, maybe third. So that's not completely new, but this is the first time I can think of, and certainly not a history buff, but first time I can think of where we have one candidate that might end up in jail and another candidate that might get assassinated by gravity. And I will leave it up to you guys to determine which candidate is which. Might be something that could happen to both. So anyhow, so let's say we're in an election year and we're trying to look forward to what is average. What you're seeing over here is in an average election year, these are the returns by month. And so what you end up seeing is it's very positive and, a couple negative months, but that's pretty normal in all years. What I would say, and I'm going to tell you my long-term election thoughts on this, and then I'll tell you this year in particular. One, long term, I think a lot of it has more to do with the economy and the markets and where they are in their cycles than the actual election of, whether it be midterm or presidential year. What you do see, though, is a little bit more volatility right before the election, which tends to make sense. But what you see afterwards is a lot of strength, which also tends to make sense, because I'm a firm believer in the American economy and American business. And regardless of who's elected, businesses are going to find a way to make money. They always have. And as long as our economy, stays the way it is, they always will. And what an election changes is maybe a little bit of what the playing field looks like. What type of regulations are they going to have to deal with? What type of tax situation are they going to be encountering? And then once you know that playing field, they can start making decisions and investing capital in a wise way that they may have been waiting on during the earlier parts of that year. That's not always true, but to me, that seems to make logical sense. What is true, I would say, in this year, and this is a very key point we have over here on the left, we've had 5 strong months of good returns. And I would say election, no election, after you have that many good months, a lot of times some consolidation is normal. And all that is part of figuring out pricing, as well as that. And I use the word volatility, not risk. To me, risk is something bad that happens to you that you can't easily get around. Volatility, it goes down, but if we hold those assets, history has told us that it's going to come back up. It would be normal to have that regardless of election year after the type of market move we've seen. Also, when you're having volatility, or even in a situation like we're in now where equities have gone up a lot for the last 5 months, one of the best things you can do is take advantage of that by doing some rebalancing. And certainly a lot of our clients are selling some equities to buy bonds right now. When markets go down, it's usually the reverse. We end up selling some bonds to buy stocks, and that can be a powerful, really almost passive strategy, because what it tells you is, all right, if this is my target and I get away, it's time to trade. It's not me sitting here going, all right, my fingers in the wind. What does David Elder think is going to happen to the market over the next month? That could be dangerous. So we'll probably see some more frequent rebalancing. Also, one of the things we've seen, and this has nothing to do with the political cycle, in my opinion. There are some arguments that, all the money in the system during COVID led to inflation, which is true, but I don't know that that's necessarily a political issue that both parties didn't agree with. But what is true from an economic perspective is rates have gone up. And when rates go up, you do see typically some more volatility, but once they stabilize, you start to see a much more stable looking market. And so that is a possibility too that could happen. And again, none of these are election related except for this historical chart you see over here. And so then you got to think, okay, so how am I going to get my election news, and what is that going to tell me about my portfolio or money if I want to watch, Fox News or CNN or CNBC or MSNBC or, ABC, whatever, get that news and then try to use it to make financial decisions. And I would say even at the perspective of Money Magazine, probably the best I've seen for being true journalism would be the Wall Street Journal, but that's in my opinion. Not everyone would agree. But even at the Money Magazine level, what the news is really doing is trying to sell the news. If it's a TV show, they're trying to get viewers. If it's a magazine, they're trying to sell magazines. If it's a newspaper, they're trying to sell papers and ads. What they're not trying to do is give you true journalism. And I hate to say that, but it's the world we live in now. And social media is even worse. What they're trying to post is things people will click on, not things that help people truly discern what's going on. And this is why, really, in our educational system, and I don't mean this statement too big, because a lot of people can do this intuitively. It's kind of common sense, but we don't truly focus on teaching people how to research and know a good source from a bad source until you're really at the undergrad, but especially graduate level. And then they even take it to another level at the doctoral level. But before that, it's just not something that most people think about. And it's also something that we quickly forget. And the reason we forget it is both our herd bias, our familiarity bias, and some of us a newness bias, which would be, what do I hear today? And does that matter more than maybe what I heard a year ago? So all those things, remember when you're watching the news, they're going to try to make you afraid so that you watch them more. And I will say, especially on this election, and again, you can decide which candidate this is. One of the candidates has the job of making it sound like America is doing as poorly as possible because that's his best road to the White House. And we have another candidate that wants to make America sound like it's doing as good as possible. So don't be afraid. Don't be surprised when certainly the candidate that wants to make America look like it's doing as bad as possible is trying to scare the crud out of everybody. All right. So with that, my advice is know that this is coming. Don't let it drive your financial decisions. So what we looked at here is what should drive your financial decisions. And one of the things I wanted to show is a lot of times it's not what risks can happen. So this chart, it's my absolute favorite marketing piece ever put together in the financial services industry. And what it is, and I'm going to zoom in and go into some specific years and some specific numbers with you guys in a minute. But what this is really talking about is it's showing a mutual fund that you could have invested in back in 1934. All of us who know a little bit about history know the economy was pretty terrible in 1934. What would have happened if you had held that up until today? And the initial investment they're talking about is $10,000. And let's see, in today's dollars, that would be the equivalent of investing. I don't know that exact number. Let me see if I can find it. Something in the neighborhood of like 30,000, something like that, but nothing ridiculous. Nothing that, really most of the people we work with, would be out of their league. So what it's showing is how much money that built to, and I'm just going to bring over this PDF of this chart that we can really zoom in more. All right, so we started off here with $10,000. Obviously, it went up. Then obviously we had some great runs early on. Then, and yes, all right, if you want to cherry pick this, the reason we had this great run here that I'm pointing out is because this is post 1929 crash. But guess what? This fund didn't exist until 1934, so that's where we're starting. And if you come all the way out here, if you just left that $10,000 invested all the way to the year 2020, so it's not necessarily one person's lifespan, but certainly could be one person who invested at, let's say, 30 years old and lived to 80, and then their family inherited the money. And we can run those numbers here, and also send you all a PDF if you want this, so you can look at different, starting times and where that would have gone. But if you just held that, so we're holding it for 90 years, that $10,000 would have grown to $197 million. So here would be, if we're in a group setting and we could see everybody's hand, or maybe we're use some virtual hands, I would ask you the question, how many of you guys know someone with $10,000? And I bet every one of you would raise your hands. And then I would say, how many of you know someone with $197 million? And I doubt many of you, well, I mean, I'd raise my hand and say, yeah, I know Bill Gates and Elon Musk. I don't personally know Bill Gates and Elon Musk. I don't think on a personal level, many of us do know people at that level. We may. There are a lot of wealthy people out there that don't show it, but we may not. And then down here, it shows actually, and this is really impactful, if you didn't invest the dividends, what's the difference? And one of the things you see is those dividends made a huge difference. And then I love this line down here, which says, this chart is not drawn to scale. This chart is based on a logarithmic scale, so it uses smaller and smaller increments for larger numbers. If the scale were arithmetic, it would say 1 inch represents every $10,000. Okay, that makes sense. If the dark blue area, which it includes without dividends, would be 136 feet tall. Okay, so that's right here, which is about as tall as the 14-story building. The light blue section, which shows how the investment would have done if dividends had been reinvested, or in more shares, would be 1,642 feet tall, over 10 times the height of the Statue of Liberty. Look at that. That's absolutely amazing. This illustrates the difference between reinvesting your dividends and taking them. All right. So now we have on the top here what was going on bad in each of these years. So this is the reason why you shouldn't have been investing this year. This is what the news might have told you to scare you and get you out of the market. So for example, I mean, let's just think back in, '08, obviously we had the US financial crisis. Imagine if you'd invested then, how much money you'd have today. We've all ridden, or at least watched, the S&P 500 ride that up. We had something in, 2020 here, COVID pandemic. Well, a lot of people freaked out. The market went down sharply. It came back fast. And so I'm going to show y'all something, but I'm going to pause here for a little bit of trivia to see if anybody can come up with an answer. All right, so I'm not sharing anymore, correct? You guys just see my big, beautiful face? Awesome. All right. Who is a little trivia, and I'm going to go to a year I find to be probably, from a geopolitical standpoint, an economic debt standpoint, an inflation standpoint, and a really market standpoint, probably the scariest time in our world's history. Can anybody guess what time of frame I'm talking about? And all I'm saying is, you think things are bad today. I'm about to take you back to a time that I bet those of you who studied history and had parents who lived through this can tell you was a lot scarier than today. Okay. Anybody want to guess? Juliana can send you a $20 gift card if you get it right. World War II. Yes, ma'am. Let's send Norma Berry a $20 gift card to somewhere. Yeah, so let's go back. I mean, we're thinking about what's going on now in the world, and of course, we're scared of all these things: China, Russia, the Middle East, inflation, COVID. You know, think about how contained those are compared to where we're about to go to, which is the year 1944. Okay, so let's look at what had happened in the previous 10 years. First of all, we're coming out of the Great Depression. We got a civil war in Spain, which, really isn't that big of a deal to the U.S. economy, but we can make sound about as scary as, war in Ukraine and Russia. We have the economy still struggling. We have another recession to follow this depression, which is just terrible. War clouds gather. Then, I mean, my gosh, 1939, we're not talking Vladimir Putin here. We're talking Adolf Hitler starts marching across Europe and taking over countries right and left. France falls in 1940. So now we know we're going to get into war. We just don't know when, and we haven't publicly said it. But the U.S. financials at this point are pretty terrible because of the recession. We have a massively high unemployment rate, and we're going to have to take on more centralized government debt to fight the upcoming war than we have today as a comparison of GDP. So everybody who thinks we have a very high debt today to GDP or high national debt today, go back to 1944. It was more. It was significantly more, but we knew we had to do it or else we couldn't have fought the war. Then Pearl Harbor falls. So now all of a sudden we're fighting on two fronts. Industry mobilizes, which is actually a really big positive in 1943, but at the same time, it was kind of hard because we had a shortage of workers because everybody's out at war. And so then what do we have in 1944, which gets us back to hyperinflation? Oh my gosh, a consumer goods shortage, which isn't the same as what we had in 2022. It's a lot more like toilet paper was in 2020, where all of a sudden, normal things, you just couldn't get them anymore. And then we go into the post-war recession, and then look at this. Finally here, the Dow Jones tops 200 for the first time. Does anybody know where the Dow Jones is today? This will be for another little $20, or let's go with 5 because this is an easy. I don't know. We'll figure out the number later. We'll go with 20. Who wants to tell us where the Dow Jones is today? About 40,000. Think about how many times that thing has doubled since 1944. Let's go back to this chart. Think about if you could have put your money in the market in 1944 and not even left it in until today, but just left it in until 1984. So you're 25 years old, you're back from the war, you put it in, you work the next 40 years. How much money do you have? So it's right here on this line. Let's see, maybe right at, it's about 2 million. It's doing well. So anyway, I hope y'all enjoyed that slide. Happy to give it out to anybody that wants it. Otherwise, I will pause for any thoughts and questions on some of the stuff I've said so far. So we got one in chat. It's just World War II. Okay. All right, great. All right, let's get a little more election-y again, instead of just context. So with elections, there's always statistics. And I think there are statistics that you can correlate to the market that are valid, and there's statistics that are very invalid. I guarantee you, I can give you a correlation between what the market does the year after Tom Brady wins a Super Bowl, but that tells me absolutely nothing about what the market actually does. It's just because, randomly, they happened at similar times. So that, there's correlation and then there's causation. And then there's statistical relevance and all that stuff. So anyway, here's the return in all years average since 1933. What you can see is non-election years have been the strongest. Presidential years in the middle, midterms have been the lowest. I don't know if that's because of the politics or just because. But what I do know, and this is significant data, all of them are positive. And so whether I make 15% this year or 9%, at least I'm making money. And making money is the difference of needing to have fears. And then over here, we did do it excluding 2002 and 2008, just to show how the numbers would be different. What is so different about 2002 and 2008 for the presidential election and also the midterms that happened then is just, massive economic shock that really had very little, if nothing, to do with the politics at the time. I mean, certainly 9/11 and 02, the impact that had on our economy and markets, and then the Great Recession in 08 and the impact that had. But I thought this would be interesting, which is going back to 1926, under what type of administration has the market done the best? And what you will see is it's not clear cut. If you actually do the numbers, it has done, I think, just by pure coincidence, better under Democrats, but it's made a lot of money under both Republicans and Democrats. And you don't necessarily see a huge difference either. I mean, I look at something like the Bush years, and it was pretty flat. He was one of the few presidents that it was negative over his entire term. But, I think a lot of that had to do with economic forces that, if I'm going to politically blame anybody, got set place in the 90s. And quite frankly, were more free market oriented and banks wanting to make bad decisions on bad loans than they were government oriented. I mean, you had banks doing things that good banks should not do. So anyway, just thought y'all would find this interesting. Stopped in 2019 just because that's where the data stopped, but I think it tells the story that we're trying to see anyway. And then even more important, and this is really interesting to look at because you could overlap these two charts, but what are these cycles between bull markets and bear markets? And what you will find is bull markets in general, they have two things that really stand out to me. They're the ones in blue, and obviously going down in kind of the brownish is the bear market. The bull markets are longer and they're bigger. And that's fantastic. Now, I would say at the end of a nice bull market like this, no one's ever thinking, right here or right here, wow, something's really wrong with this market. But at the bottom of the bear market, they are, and everybody's very, very scared. So what you need to do is remember that, one, these bear market cycles are very hard to time. Two, they aren't the longest lived, on average about 18 months. And three, if you overlap them, that can make you have a jaded view of maybe how the markets do under a certain administration or political regime, but it's not going to, they can't actually control the business cycle. It's just a natural part of capitalism. So hope this is useful to you guys as well. And with that, I will open up to any thoughts and questions. Obviously, we got through this in about a half hour, which is a lot less than some of our normal webinars. But I found also that some of our best conversations and back and forth, and really most useful times where both I learn from you and you learn from me, are during the Q&A session. And so, if you'd like to meet with myself or one of our other wealth managers, you can click that QR code. The beautiful Miss Juliana will set you up and figure out who the right advisor is for you. Hold on, I'm going to share that again because I had that down, because it says thanks for viewing. Okay, share. There we go. Okay, and Juliana would pop in here, say hello, even shows her face, but she's sick today. So help her out and schedule an appointment to make her feel better. All right.
I think there's somebody typing, David. Yes,
yeah.
But you all are so important. So
she's making sure you have her address because she knows we're sending her money.
And also, can you share the screen one more time? Um,
Sure.
so it's like, how do we request the market history chart you mentioned, and could you share with us?
We can email it to you. We have a PDF. Yeah, absolutely. I can share it with you. It is compliance approved and FINRA approved. Yes, sir, or ma'am. In fact, Juliana, you have the email list of everybody who came. We can just send it out to everybody who was on that. Doesn't
Yes.
have to be today. We can wait till you're feeling better.
Okay, sounds great. Thank you. And Norma, Carly Hensley's my advisor. Sounds great. If you want me to schedule a meeting with and review with her, absolutely. So we all work together as a team. So
Yeah. Yeah. Norma, what I would say about that is Carly Hensley's a great advisor. Stay with her. And
yep.
I don't know when y'all last met or what you specifically need to talk about, but if you have anything you need to specifically talk about, yeah, absolutely schedule an appointment. But don't just schedule it because I told you to. If you and Carly met like last month and already covered something, I'm really talking about people who either aren't working with an advisor or, want to meet about something new. I can certainly see, um, I can see lots of reasons. Some of these situations change. They need to update their estate plan. Somebody's, they hear this information and they want to get some money that was on the sidelines because they were afraid, back in the market. There's a lot of different reasons to meet with your advisor.